This video is brought to you by Seeking Alpha. Get in on extended Black Friday pricing for a $90 discount on Seeking Alpha Premium, a $140 discount on Alpha Picks, and a whopping $289 discount on their bundle offer featuring both. Links in the description. Like many of you guys that follow me, my introduction to value investing back in the day was this little book called Rule 1 by Phil Town. Now, I love this book. It really is the best material that will get beginners into the Warren Buffett stock picking strategy. That is the best material that isn't Introduction to Stock Analysis from New Money Education, right? But in this book, while going through all the examples about how to understand the business, how to find a competitive advantage, assess the management team, and value shares, there is a section called the 3 tools. Now, the chapter on the 3 tools is actually a deviation away from value investing into the world of technical analysis. And I remember getting very excited when I learned that there were supposedly 3 technical indicators that could tell us when a stock is going up or going down. And I remember spending many hours looking on the Yahoo Finance interactive chart at exactly what Google or Microsoft or Facebook were looking like on the charts. And the crazy thing is, it seemed to line up. When the 3 indicators lit up green, the stock more often than not went up, and vice versa. When the 3 indicators flashed red, the stock would come down. It was all very exciting. But as time went on, I found myself using these indicators less and less. Until now, I don't use them at all because I've found a strategy which actually works a lot better for me. So in this video, I want to show you firstly what these indicators are and how they work, and explain why I no longer use them and what I do instead that works far better. So the 3 tools are this: the moving average, the MACD, and the stochastics chart. Let's run through all 3. First, the moving average. So what is a moving average? Put simply, the moving average tracks the average of a stock's price over a certain period of time. So let's put up a stock chart of, say, Google, and now I'm going to add a 10-day moving average. And for those playing along at home, if you open up the Yahoo Finance interactive chart on any company, in the top left, you should see a button for indicators, and that's where you can add any of these next to your own stock's chart. In Phil's book, he uses the 10-day moving average, so let's just put that one in. And as you can see, we now get a second line superimposed onto the stock price line. Now, the idea here is that stock prices usually move in waves, right? They rise for a period, they fall for a period. What the technical guys look at is they look for when the stock price crosses up or down through the moving average line. If the stock price cuts up through the line, then they use that as an indicator to buy the stock. They say it's going through an up phase. And then conversely, when the stock price falls down through the moving average, they use that as a sell trigger. That's the first indicator, the moving average. And as you can see, generally works. If you follow the triggers, you generally come out on top. The only problem, sometimes that signal doesn't last for long. So you really have to pay attention and watch these stocks every day to make sure you don't miss a reversal. But with that said, the next one I want to talk to you guys about is the stochastics. So the stochastics chart looks like this. This line here is what we call the buy line, and the other is called the sell line. And what we're actually looking at is the movement of the big money into and out of the market. So when the stochastics chart rises, it means the money is funneling into the market, and this causes more buying pressure and the stock price will rise. And then on the flip side, when the chart starts downsloping, that's watching the big money pull out of the stock, collectively selling. Now, on the stochastics chart, we also have these 2 lines, a 20% line and an 80% line. And these thresholds help traders identify possible reversal points based on momentum in price movement. So when the lines pass up over the 80% line, the stock is said to be overbought. And conversely, below the 20% line, it's said to be oversold. Now, let's get back to the buy and sell lines. What traders really look for is periods where the buy line passes up through the sell line during a period where the stock is in that oversold area. When that happens, there tends to be a higher likelihood of the stock rising in the near term. Then conversely, when the sell line crosses up through the buy line in the overbought area, that's a sell signal for traders. And once again, when you look at this chart play out in reality, generally speaking, it works. I mean, nothing's ever certain in the stock market, but you can see it generally works. So that's the stochastics chart. And then the final indicator that is mentioned in Rule 1 is the MACD chart, also known as the moving average convergence divergence. And as the name suggests, this is a chart plotting 2 lines, one of which is the difference between a short-term moving average and a longer-term moving average. These are usually 12 and 26-day moving averages. and that's plotted next to a signal line, which is a 9-day moving average of the MACD line. So long story short, as you can see, the two lines run away from each other, and then they converge to cross over, and that's what the column graph around the x-axis is plotting. What traders will watch are the points at which this column chart, which creates these rolling hills and valleys, crosses up or down through the x-axis. So when the column graph passes up through the x-axis, that's deemed a buy trigger, and when the columns cross down through the x-axis, that's deemed a sell trigger. And what do you know? Again, we look at this indicator, and more often than not, it works too. So as you can see, it sounds like this technical analysis is the way to make millions. And honestly, in the early days, I thought that it was, and that's before I really understood the power of long-term value investing. And a lot of people still to this day ask me the software that I use in my research and my calculations, and if I'm honest, there's no software, it's mainly just Seeking Alpha Premium. Over there I get 10 years of financial data, I get explanations as to how the company works, I get unlimited news and research articles, a ton of valuation metrics, I get comparison to peers, quarterly earnings reports, and a lot more. Then if I'm looking for new stocks to start researching in my spare time, well, Seeking Alpha's Alpha Picks is really helpful to highlight stocks that I might want to look into further. Now, Seeking Alpha have decided to extend their Black Friday offer for viewers of the channel. So if you use my referral link in the description or the pinned comment, and you do have to use that link, you can now get a $90 discount and a 7-day free trial on Seeking Alpha Premium, which is mainly what I use. You can also get a $140 discount on Alpha Picks. And if you want to bundle the two together, you can get a $289 discount on that bundle. So I would recommend you check them out. As I say, I use it all the time. It's one of the few paid subscriptions that I think investors should genuinely add to their investing arsenal. But getting back on track with the video, overall, they are the 3 tools Phil talks about in his book, and they are 3 very common technical indicators used by traders around the world. And I would encourage you guys to start messing around with this stuff yourself. You know, have a go over on Yahoo Finance, because it does start to make you feel like you've found some sort of secret hack to making money. It's certainly not a 100% success rate, and as I said, of course, nothing in the stock market is certain. But if you just loaded up these 3 indicators into a random interactive chart on Yahoo Finance, you'll see that on balance, they do typically work. And that leads me into the next part of the video. Do they have a place in the long-term value investing strategy that we all subscribe to? And why don't I personally use these indicators anymore? Well, to answer the first question, you can probably guess that I don't really think they're of much importance in the overall value investing strategy. And the reason is, really, our investment decisions are primarily based on fundamental analysis, particularly focusing on a company's intrinsic value rather than short-term market trends or price movements. Technical indicators are obviously suited to short-term trading strategies, but they are very time-consuming if you want to apply them to a longer-term approach. You can do it, but it means that, every day you have to log on and check what's happening with the stocks in your portfolio, buying here, selling there. It kind of goes against the idea of just investing in a company, right? And then there's the next problem, the clash between buying when the shares are undervalued versus buying when the charts tell you to. Now, you might use these 3 tools to tell you when to buy a stock when it's in a margin of safety buy zone, but what do you do when the stock inevitably rises out of that discount area? Do you keep going with the trading strategy and end up buying back into an overvalued stock? Do you exit and then leave the stock alone? I'm not saying it can't be done, but there are some clashes there in terms of investment philosophy. But beyond that, there are 3 more reasons why I personally decided to stop using these indicators. The first is tax. Now, I understand Phil talks about these 3 tools in the context of a Roth IRA, where there aren't any consequences tax-wise from consistent short-term buying and selling, but at least from where I'm from here in Australia, we unfortunately don't have those tax-free investment accounts. Every time we sell a stock, that does trigger a taxable event. And worse yet, if we sell a stock in the first 12 months of ownership, we pay the full capital gains tax, whereas if we hold our investments for longer than 12 months, there's a 50% discount on the taxable gain, which actually discourages this type of investing even further. So overall, tax is definitely a deterrent in using these short-term in and out strategies for me. But beyond tax, the second reason I don't personally subscribe to using these indicators is because in my personal experience, I've found a strategy that works much better for me, and that is buying undervalued long-term compounding businesses and then just holding them for a very long period of time. Probably the biggest thing I've learned over the last 12 months or so is that most of the really big fortunes in the stock market have been made from buying an undervalued long-term compounder and then just parking the bus, just sitting on that stock and never touching it. And looking back at my own portfolio, I found that that's exactly the same story for me too. My portfolio's success is really down to 3 big compounders that I've just held onto for a long time. They cancelled out all of the losers and still put me ahead of the market. So I'll link to a video I've made about this last year that goes into more detail, but it was actually Monish Pabrai that clued me into this idea with his speech, which is called Circling the Wagons. He noted that even people like Warren Buffett and his original teacher, Ben Graham, both made the vast majority of their wealth simply by buying a few great businesses and then just holding them, not dancing around trying to time exit and re-entry points, just by holding them. Kus Becker of Naspers just held on to Tencent, Nick Sleep just held on to Amazon, Buffett held on to Coca-Cola, Graham held on to Geico. And while you can argue that you can still apply this active trading strategy over the long term for a long-term compounder, I think it's just risky. Remember the stat about holding the S&P 500? If you missed the market's 10 best days over the past 30 years, your return would have been cut in half. If you're messing around bouncing in and out of a long-term compounder, there is a chance that you will miss those days, a decent chance too. Remember, these indicators typically only flash green once the stock price has already started its turnaround. So I'm not here to proclaim that one strategy is better than another, but I just know from my own experience, I haven't found anything that beats the simple buy low and then hold strategy that people like Warren Buffett have used over the decades. And then finally, the last reason I don't use these indicators anymore is just honestly time and lifestyle. At the end of the day, I made a decision that I don't want my investing to ever start feeling like a second job. I want to find great companies that have solid long-term prospects, and then I just want to invest in them. I don't want to have to check a portfolio of stocks every single day, and because of the time difference to the US, overnight as well, just to get a sense of how these indicators are looking. You've seen the pictures of traders, right? They sit at their desks all day with like 15 monitors open, buying and selling stocks all day. I mean, no judgment to those who love trading, but that's just not a life that I want to live. I'd rather be out making YouTube videos or hanging out with my friends. So overall, it doesn't really resonate with the type of investor that I want to be. I love taking my time with research, waiting for a big opportunity in a long-term compounder, loading up the truck, and then just keeping tabs on the company's performance over time. That plus the tax implications were ultimately the reasons I decided to completely abandon the 3 rules, even though they do generally work. But overall, guys, I'd love to know, do you use any technical indicators? How do you use them? If you're a value investor, long-term value investor, how do you use them in that approach? Definitely let me know that stuff down in the comment section below. Also, if you're interested in learning that full Warren Buffett style approach that I've been talking about in this video, check out Introduction to Stock Analysis over on New Money Education. The links for that are down in the description. But apart from that, guys, thanks very much for watching. Leave a like if you did enjoy, and I'll see you guys in the next one.